There seems to be a general mood towards macro which is shaking the market confidence, and global investors have started selling. So how do you propose one should invest in this kind of an environment? I mean, rupee decline and crude appreciation is definitely a concern. We can take shelter from the fact that, you know, bad macros always give you a buying opportunity, but right now are markets ignoring the importance of weak rupee and dollar strength and crude strength?
So it has to do with behavioral economics. There's nothing wrong with fundamentals today. It is about short-term sentiments, and FPIs have been sellers all throughout last year, and it is the domestics which have supported. But all these rumblings about what is the appropriate level on the rupee, to my mind, the real effective exchange rate suggests a 73 to a dollar as being not overvalued at all. So fundamentally speaking, 73 is the level for the rupee, appropriate level for the rupee. But we know that short-term sentiments can move the rupee adversely even from these levels. So it is the top-down and the flows and direction of flows. If there was suddenly very strong pull out on equity flows from the FIIs, and that is not mitigated enough by the domestic flows, then you could see some pressure. But having said that, I think the micros look pretty decent. Valuations also not excessive at all, given the growth that we see. So to my mind, that presents a buying opportunity. You're right.
Manish, the core anchor of your portfolio is essentially financials. And financials, they tend to do poorly when interest rates they rise, especially wholesale based NBFCs and wholesale banks. Are you looking at revisiting some of your rate sensitives where there is going to be direct implications of rising interest rates?
No, so it depends on to what extent banks are able to pass on increased rates in the system. I think the NBFCs tend to get a little more impacted in a rising interest rate scenario than the banks, because banks inevitably will pass on after a lag, if not immediately. So private sector banks have had a very good run over the last many years, and so is the case with NBFCs, and this is on the back of problems in the state-owned banks. But there would be short-term blips on account of this, and there could be some compression in valuations on these names, these private sector banks and NBFCs, but the growth remains intact irrespective of and the credit growth in the system, by the way, is already picking up. So that also spells out good news for let's say the volume growth in the banks per se. Margins will see some sort of a dip, and a compounded impact of both these factors would still lead to a 15 to 20% rise in the earnings of many of the private sector banks and the strong NBFCs. Housing finance companies look slightly more vulnerable because there isn't any pricing power in this sector currently, and volume growth also is not that conducive given the high risk environment that we are seeing in the LAP portfolio, in the SME portfolio. So from that point of view, I think markets are pricing all that in, but the long-term growth trajectory on many and all of these names look pretty decent. So there's no reason to panic per se, but we'll have to live through these short-term corrections.
So Manish, if you're looking at seeking the maximum benefit out of this dip in the market right now, what do you do? Do you buy the decline in cream NBFCs, buy more of Bajaj Finance, Finserv? Do you buy or rather switch out of the HDFC banks of the world, put that money into, say, buying more of an ICICI Bank or a Yes Bank or an Axis for that matter?
So what you're suggesting is absolutely right. In the short term, you could see some pressure coming out of these marquee names like Bajaj Finance, HDFC Bank, but there's nothing wrong fundamentally with the bank per se, or Bajaj Finance as an NBFC per se. I mean, it's perfectly growing, and there is a case of corporate banks doing well in the immediate short to medium term, but that does not dissuade one from owning these core names in the portfolio. We understand that Diwali is going to be very good from a consumption standpoint. All of these will get reflected in many of these marquee names also. Valuation correction is setting in across the board, whether it be consumers, whether it be, there isn't any one single sector where you could say that next 2 years of growth is not fully priced in. But these are short-term corrections, I don't read too much into it.
What's happened, Manish, recently is, and I guess this is all a part of the government providing fiscal stimulus and, getting a little populist ahead of the upcoming election. The fact that they've now provided a complete significant visibility on ethanol blending. We've seen what it's done to sugar as a pack on Friday. But do you sense that sugar is the cycle to now bet on, especially now with clarity on ethanol blending coming in? If stock prices are anything to go by, this is seeming to be the sweetest story in the market right now.
No, I don't agree with that fact. Of course, ethanol blending will provide some reprieve to the sugar mills, but you look at the nature of this business, the end benefit will always flow to the farmer, and irrespective of whether global, and see, sugar is a global commodity. Sugar prices go up, sugar prices go down. So if the end product is a cyclical and the raw material cost has to be only one way, it has to be going only one way, and that is on the upside, because it's a political commodity, and there's a lot of emotions and feelings attached to this sugarcane as a crop. It's a political stuff. So the dynamics of the sugar industry are very cyclical, very adverse. And to get PE multiples on this sort of a business would be quite challenging. Ethanol blending comes as a reprieve, but even then the sugar mills won't be making any profits.